Morning, everybody. Fair bit to get through this morning, so we'll get on with it. Richard and I are going to run through some news, and then we'll be talking to Bruce Stout of Murray International, which has been much better recently. Actually, I think he's leading his sector, which is the global equity income sector. Bits of news that we thought we'd pull out. One is to sort of finish off on this renewable infrastructure NAV discount story. So there's been quite a few announcements this week that tidied that up, I think. Additional line infrastructure because they've lost their managers, NB Global Monthly Income because it's going to give up the ghost, and then Home REIT because it's been attacked by a short seller. So renewables infrastructure NAVs first. There's been a fair few announcements, as I said, this week. Generally, they've all been positive though, which I think is encouraging. Foresight didn't actually announce a new NAV. They just said that the impact of the tax was to drop the NAV by 0.8p, which is hardly the end of the world. So we'll run through some of these. Just bear in mind, though, from what I was talking about last week, the £10 million kind of de minimis threshold that I thought was a threshold, so you'd still pay tax on the whole 10 million if you went over the number, is actually deduction. So actually that makes the amount tax payable even lower than we thought. And there's still a story running in the background because apparently Theresa Coffey was asked in the Commons about a plan that Liz Truss came up with to restrict renewable solar on what they call 3B agricultural land, which is actually most of what they've been building the solar on, and they're still planning to do it. That could become a headache in the future, but maybe not the end of the world. We'll have to wait and see. So Renewable Infrastructure Group first. In their Q3 numbers, it's very similar story all the way through on this then. So the ramping up power prices are adding to the NAV, but the tax reduces that again. So that the net of those two, as you can see there, is to add 0.4p to the NAV. And then same thing, inflation, that adds to the NAV, but discount rates drop it again. 0.5%, you'll see that coming up over and over and over again. It's almost like they got together and agreed this was the number they're all going to use, but I don't think they actually know how to do that, so that it's just a coincidence. But it does seem to be that that's the amount that everybody's been lifting up their discount rates by, which is when they try to calculate the NAVs and looking forward cash flows. It's got operations in the EU, but it doesn't think that the price cap's a problem for them. One thing that did pop up in the NAV, and it's kind of buried in there, is that they had the wind generation was actually a lot lower than budget, and that's common to other wind generators too. So definitely at the moment, solar's been doing much better than wind. It just hasn't been blowing as hard as it should have been. But things tend to be swings and roundabouts. We'll see how it works out. Next energy, so quite a decent uplift in NAV over the 6 months ended 30 September, 9.4p. Again, driven by power prices. So what they did, and again, this seems to be common across the sector, and I think they must have talked about this in advance, is they applied discounts to the power prices that the independent forecasters had come up with for the future. So I think Next Energy took about 50% off the numbers that were forecast for next year, and then to 35% for the year after, and it sort of goes down there from through all the way to sort of 26-ish. Inflation obviously positive, but this operational outperformance number 3p, they're quite pleased with that, and I agree with them. So that obviously sunshiny helps, but also just managing to keep your stuff operational, so you don't have any sort of unplanned outages. That makes a big difference, and they think that's going to be a big differentiator going forward. So well done to them on that. And they're very bullish about their dividend. So most of funds have sort of reined back on the idea of matching inflation with their dividend increases. Next Energy still feel that they can do it, and their dividend is quite well covered, so 1.3, 1.5 times at the moment. And they can look forward because they know what the subsidies are going to be, and they also know that they've sold all the power forward, what the sort of power sale revenues are going to be next year as well. So that's really quite positive, I think. So we should see a decent uplift in the inflation in the dividend next year. Bluefield, again, very similar story here. Again, 0.5% on the discount rate. They're estimating inflation for 23 at 5.5%. I still think that might be a bit low, so there could be more upside to come from that. We'll have to wait and see how we go. Importantly, for what we're talking about on the DEFRA thing, they've already got planning for 4 sizable sites, 215 megawatts. So those things can go ahead regardless of what happens now. It's really down to then how are you going to sell the power in the future? Obviously, they'll have to sort of weigh in the effect of the levy, which is going to carry on running. But it may be that they're able to bid in the next auction round. So remember that they've already got a couple of sites that they agreed contracts for difference for. So that, there's a sort of fixed price that escalates in line with inflation over the time. And that made sense to them last time. So we'll have to wait and see when the next auction round comes around whether they bid those 4 sites in as well. I think it's quite possible that they will do. Downing, it's not affected by the tax at all. The interesting thing with this one, I thought, was that the foreign exchange was positive. So that added 4.3p to the NAV. And they've hiked their discount rates. They're the only ones that didn't do 0.5 for everything. So they only added 0.3 to the Swedish stuff that they've got that hasn't got debt attached to it. Obviously, if you've not got debt attached to it, it's less risky. And they've been investing more. They bought some more Swedish hydro plants for 6 million quid just a couple of days ago, and they've still got 28 million pounds of cash left to deploy. So we like this one, as you know, and I think it's doing quite well. And then just to tack on the end there, although INPP said something, they didn't really sort of clarify it with numbers, but HICL were, outside of the renewable sector, they also raised their discount rates by 0.5%. From what I was ranting about in my Citywires call this week as well, about the fact that the various things that the government have done have encouraged people to invest in infrastructure abroad rather than in the UK. That the big investments this last 6 months were in France, New Zealand, and the US. But actually, I think it's this message down the bottom here that's probably the key takeaway from all of this, is that they're saying that actually the risk premium, so if you remember how these discount rates are worked out, there's obviously the government kind of risk-free rate and then a risk premium on top. They're saying that expanded to quite high levels in the run-up to this. As interest rates were coming down, the risk premium was kind of going up and the discount rate wasn't coming down in line with interest rates. And so therefore, the fact that these things are reversing, it doesn't really make a difference. And this is why it's only moved by 0.5% when the interest rates are moved by more than that. This is why these things aren't linear. So I think that's sort of like maybe the key message in all of this, really, that there probably isn't a lot more downside pressure. So upside pressure on discount rates, downside pressure on NAVs. So given all of that, then, so we've now got complete clarity on what the windfall tax, how the windfall tax works. We know what the discount rate impact is, and for a whole bunch of funds, it's already in the NAV. It doesn't really make sense to me that so many of them are still trading on these big discounts. So I think now we should be seeing most of these close. There are specific reasons for some of them why they're being problematic, like the energy efficiency ones, where they would struggle to get money invested. But for many of these other ones, I do think that these discounts are too wide, and they should be narrowing in now. Digital 9, I'm talking about discounts. So the massive ones just opened up over the last few months, but really it's this drop here that we're looking at today. And the reason is because the managers are gone. So apparently the story is, and this has come from Stifel, that they wanted to launch, they were frustrated that the fund couldn't expand because it was trading at a discount. And so they said, well, in that case, then we've got things to invest in. We've got people who are actually giving us money. We're going to go and launch a private fund to run, an LP type fund to run alongside the listed vehicle. That's not something that I would have had a problem with. I think it's not something that most of the investors would have had a problem with, but the board didn't like the idea and led to a bust up, and so they walked out. The temporary manager they've got is senior within Triple Point, but doesn't have any digital experience. They've been trying to reassure the market by buying lots of stock. So the managers bought £500,000 worth. The directors have all been buying shares too. And that doesn't seem to have stabilised things yet. We'll see how we work out. The fund's been quite busy since it launched. So this is from their last interim results. So there've been quite a lot of acquisitions, quite a lot of fundraising. Last lot of fundraising, 60 million quid in July, and maybe they wanted more than that. But it was difficult conditions for everybody, as we know. And actually, again, that was quite good news, I think. So they've still got a pipeline of stuff lined up, which I don't know whether that's going to be capable of being executed without the managers being there. We'll just kind of have to wait and see. But I do think they probably do need to go out and recruit replacements for these people, because it's quite a complicated portfolio. Even though each one of these businesses has got its own management team running the thing, there's a lot of moving parts in this now, and it needs somebody with expertise to run the thing. So we'll see what happens. NB Global monthly income, decent size-ish, not too wide a discount. That's actually narrowed in recently because of the announcements just come here. Big yield. All of this sector has struggled for the most part. Almost all the sector has struggled because rates have been rising. And if you're investing in fixed income stuff, that's driving down the NAV. But this is different because it's invested in floating rate income. And actually, when it was launched back in 2011, that was in the name. So it just was quite sort of explicit that was what was going on. Obviously, you launched in 2011 with floating rate portfolio, and interest rates go down, and your income's going down, and you're struggling. And so that's made it probably a bit unpopular for quite a long time. But now these things are reversed, and we've seen quite a sharp ramp up in the yield on the portfolio over the current year, from 6.3% at the beginning of the year to 9.9% at the end of October. The yield to maturity of the portfolio at the end of October was 13%, which is really quite chunky. They've been hiking the dividend. So they pay us like a target distribution based on the NAV, and they've done that twice already this year. It's the sort of fund that ought to be flying out the door. I think they should be, it should be trading at asset value and raising money. It's not though. The managers aren't worried about defaults, but maybe investors are. And that's reasonable to do that, because obviously if we go into recession, then some people are going to struggle to pay their debt. And definitely some people will struggle with higher rates of interest as well, because obviously the interest bill is rising. But you remember you've got that 13% there, your maturity. So even if you lose a couple % of that, you're still earning decent returns. And the other thing is that the NAV has been trending down as the yields go up. So we've got a period now of the performance doesn't look very good because the NAV is going down, but the yield's going up. But for new investments that they make, they're actually getting really quite attractive numbers. So they've been offering these semi-annual exits. And the last one of those in July was undersubscribed. And you would have thought, again, that's good news. They only showed by 10%. But there was one plan for December, and the board said, we've got a sort of hard limit of 150 million quid. We think that it's going to drop down below that. So instead of doing that, we're just going to wind the whole thing up. Might take up to 2 years to do it. But, well, we'll see how it works out. Because they did actually raise the cash for the 7th of July tender much faster than they expected. I suppose there are some liquid things in the portfolio. So basically what I'm saying is that I think it's a real shame this is disappearing. It's exactly the sort of time when it ought to be coming into its own. This is the time when actually floating rate stuff ought to be quite attractive. But they maybe just needed somebody to go out there and bang the drum, and they didn't have that. So there we go. Now, I'm going to hand over to Richard, because there's another story which has caught our eye.
Cool, thanks, James. Yeah, so a short seller, Viceroy, published a report on Home REIT. Quite serious allegations within the report. We haven't had much in reply from Home REIT yet, other than it refutes the allegations as misleading and inaccurate, and that they'd make a full response in due course. In our view, they should do that as soon as possible, because like I said, these are really quite strong allegations. They got their results coming out on Monday, so I'm pretty sure that they will within those make an announcement and really sort of reply to some of these allegations. So just by way of a reminder of what Home REIT does. So it launched in 2020, raising 240 million IPO, and it provides accommodation for the homeless. And the good thing about these things is that the local authorities have a legal obligation to house homeless people, and the accommodation that they use has traditionally been sort of B&Bs, hotels and things like that, which are really expensive. And the accommodation that Home REIT is providing is at a massive discount to what these are. So it's good for the local authorities, and it's good for Home REIT as well, because it's government-backed income. Basically, the charities that run the homes get housing benefit from the local authority and pay the rent through that effectively. The rent is inflation linked, has a cap of 4% and a lower limit of 1%. And at IPO, they were targeting a total shareholder return of 7.5% over the medium term once it gets going. So it was quick to deploy the proceeds. It had a portfolios already lined up, so it deployed those proceeds within 5 months. And then earlier this year in May, it raised another 263 million in a massively oversubscribed placing. I think they were looking at 450, so it's hugely oversubscribed. That promoted them to the FTSE 250. They've pretty much deployed all of that as well. So at their year end falls on at the end of August, and at that point they had 2,239 properties, 29 different sort of charity tenants, and average lease length of 24 years. Since then, they've bought another 220 properties. So they've now got just under 12,000 beds for homeless people, which is pretty good going in about 2 years that they've been running. They've still got 30 million of cash to spend. So moving to the allegations that have come up in this report. So there's allegations on, or concerns on the tenants, the strength of the tenants, and their ability to pay the rent, similar to Civitas and the short seller attack that they had last year. So they've said in their report that they've looked into these tenants. Many of them can't afford the rent. They don't have the sort of financial backing to be able to have these sort of 25-year leases, which some of them have. And earlier this year, Circle Housing, which was one of the biggest tenants within the portfolio, went into administration, which obviously isn't a great thing. But the administrator is still paying the rents to Home REIT, and there shouldn't be. There's no impact on the individual sort of tenants, the vulnerable people that live in this accommodation. But there's a massive discrepancy to what Viceroy is saying, which is some of these tenants aren't paying rent. They haven't been able to for the last few months or longer. And Home REIT earlier this month put out an update saying that 100% of rent has been paid in the year. So it's quite an easy one for them to refute. That they've got the stats, they know what's been paid. So they need to come out quickly and sort of squash that one, because the longer they don't, the more people will assume that it's correct. Another one of the big allegations is on valuations. Now, they've been quite punchy in their language in the report, saying that they've systematically inflated the prices on their balance sheet. insinuating really that because the management fee is done through NAV, they're inflating this to boost the NAV, to boost their management fee, which obviously is fraud, really. And they've actually used the word fraud within their thing, which is, like I said, it's very, very punchy to be throwing that around. So they alleged that they acquired portfolios of properties. So they used a couple of examples within the report, and they're sort of area specific. So there's one in Stoke, portfolio of 34 properties acquired in December 2020, and they used they got hold of the list of properties that they bought from their mortgage provider, and then they cross-referenced the properties with HM Land Registry's price data, and looked at how much they paid for each property, and it had previous history of what's been paid. And so the couple of examples that they pulled out was the Stoke portfolio, where all the properties, individual property prices were what you'd expect, and then there was just one outlier which they paid almost £5.9 million for, one like standard terrace property in Stoke. And that's a massive red flag for me, and I'd love to hear what they've got to say about that. There was another one in Plymouth as well, which is exactly the same. Yeah, and I don't know why they've done that. Maybe there's a perfectly reasonable explanation on that, but like I said, they need to come out and explain this, because on the face of it, it doesn't look good. And then on the management team, this is a bit of a joke really, because they talk about the management, the fee structure is perfectly aligned to commit fraud. Like I said earlier, that with the boosting the NAV to increase their management fee, but the management fee is based on NAV, and that's commonplace across all investment trusts, and it's pretty reasonable. I've put them down there, and that, like I said, that's the same across all of it. That doesn't mean everyone tries to overpay for things, and because that's just nonsense in my view. But the fundamentals of the sector are the same, and it's the same for the social housing guys as well. There's a massive need for this. There's a massive undersupply of this stuff, and the government haven't really got the wherewithal to deal with it. So funds like this come in and fill the hole really, and it's good stuff. But like I said, they need to come out, and I'm hoping to see on Monday when they do their results that they go through this point by point and squash it really, because yeah, it's quite a serious allegation. So, but these are short sellers, and that's what they do. So
exactly. I mean, there's a Tony's actually put this in the question. It's going to be something I was going to say, but that it could just be that the land registry's made a mistake on that. Yeah, it could be. Yeah, it could be a reasonable, like some completely innocent and like a mistake. So yeah, it'd be really interesting. But they've got to come out quickly, because this has been out now since Wednesday. It's now Friday, so they've had 48 hours to say something. Do you say they got results on Monday? Is that right?
Yeah, that's in the diary. Whether, well, they'll have to come out with something then.
Okay, we'll look out for it then.
Yeah.
One question here that we should answer probably: do you think it has a read across to the rest of the sector?
Well, the social housing sector's a bit different. It's regulated. They're both regulated by different sort of regulators. So, as we've seen with Civitas and Triple Point in that sector, the regulator's been really hot on looking into the housing associations. In this sector, it's less I can't remember the name of the regulator that does this sector, but they're less on it than in the social housing sector. So there's not really individual reports on these guys. So there's no real sort of yeah, in my view, they're two slightly different sectors, social housing and the homeless sector. There is a cross, but yeah, I don't think so.
All right. Thanks, Richard.